When the Iran strikes began, markets did something unusual. Brent surged on the initial open, then just kept climbing, crossing $100 a barrel. The dollar eased all of its year-to-date losses in a single session, and then equities fell sharply, with Asian markets taking the hardest hit. But there was one move that didn't fit the usual script. Bonds sold off too. Now, normally in a geopolitical shock, investors flood into US Treasuries as a safe haven. So prices rise, yields fall, and the bond market acts as a cushion. This time, the opposite happened. The 10-year Treasury yield posted its biggest single-day advance since October, and that's kept rising since. And that's its biggest weekly move since last April. Bond markets weren't pricing a recession, they were pricing inflation. Even gold, after an initial spike to a record high, pulled back as rate expectations rose. So that's the opportunity cost of holding a non-yielding asset, crowding out this countervailing force, which is the safe haven bid. So bonds selling off, gold selling off, equities selling off, oil surging, that's the stagflation signal. And that's what makes this very different from every geopolitical shock that we've had in the last decade. Now, before we get